Have you ever looked at a big company's earnings report and
hmm
wondered, what's really going on behind the headline numbers, especially for a major energy company?
Yeah, those releases can be dense, lots of figures, different kinds of earnings.
Exactly. So today we're doing a deep dive into Dominion Energy's second quarter 2025 results. They just put out the news release on August 1st.
Fresh off the press.
Right. Our mission here is pretty simple: pull out the key nuggets, help you understand what the numbers actually mean, and sort of navigate this world of corporate earnings.
Okay, let's unpack this.
And it's important stuff. I mean, this isn't just for stock market folks. If you're interested in energy or how utilities work, or even just the broader economy,
hmm
these reports give you a real window into their performance, both past and, potentially future.
Absolutely. So let's jump straight into those headline numbers.
Yeah.
Q2 2025 versus Q2 2024. At first glance, it looks, well, pretty good for Dominion.
Looks strong. Yeah.
Their GAAP net income that's generally accepted accounting principles, it hit 0.888 cents per share this quarter.
Which is a nice jump from 64 cents per share in Q2 last year.
So decent increase there.
Yeah, in dollar terms, that's $760 million this year versus $563 million in 2024.
Okay. But then there's usually another number, right?
Always. That's the operating earnings, the non-GAAP number they talk about a lot.
Yeah.
So those came in at $0.75 per share for Q2 2025. That's also up from Lever and 65 per share last year.
So 75 versus 75.65, also up.
Yep. Total operating earnings were $649 million this year compared to $567 million in 2024. So, the quick takeaway: both measures, GAAP and operating, are showing significant year-over-year growth.
That's the main headline then. Growth across both metrics.
And maybe just as important, the company also reaffirmed its full-year guidance for 2025. They're sticking to that $3.28 to $3.52 per share range for operating earnings.
Holding steady on the outlook. That's usually seen as a positive sign. No surprises there.
Right. Which brings us to the elephant in the room you mentioned. Why two sets of numbers, GAAP versus operating?
Yeah, this trips people up sometimes. What's fascinating here is that Dominion Energy explicitly states they use operating earnings, the non-GAAP one, as their primary performance measure.
Primary. So for everything.
Well, for public communication, definitely, but also internally for their budgeting, for setting incentive compensation, even for figuring out their dividend payouts.
Interesting. So management bonuses might be tied to that number?
Very likely, yes. Their reasoning, as they put it, is that operating earnings provide a more meaningful representation of the company's fundamental earnings power.
Okay. Fundamental earnings power. So what does that mean in practice? What's the difference?
It's about stripping out certain items that can cause, volatility in the GAAP numbers, but aren't seen as part of the core day-to-day business.
Like what kind of items?
For Dominion, it's often things like gains or losses on their nuclear decommissioning trust funds, NDTs. Those investments fluctuate with the market.
Okay. Makes sense.
Also, the mark-to-market impact of some of their hedging activities and, other adjustments that pop up now and then.
Gotcha. So things that aren't directly related to selling electricity or gas.
Pretty much. For example, in this specific quarter, Q2 2025, there was a $157 million net market benefit, mostly tied to those NDTs. That helped boost the GAAP number compared to the operating number.
So that explains a chunk of the difference between the $1.88 GAAP and the $1.75's operating.
Exactly. And the company is upfront that they can't really predict these kinds of things accurately in advance market swings, extreme weather impacts, maybe future acquisitions or sales.
Right. Too many variables.
So they can't give you a reliable GAAP forecast that matches their operating earnings guidance. Operating earnings give them, and they argue investors, a steadier view.
Okay, that distinction is really helpful. So if operating earnings are their preferred measure of core performance, let's dig into where that performance is coming from, the segment.
Yes, this is where you see the moving parts.
This is where it gets really interesting, I think. First up, Dominion Energy Virginia, big segment for them.
Huge. Their home base.
And it really performed. Operating earnings were $549 million in Q2 25. That's up $64 million from the same quarter last year.
Wow, a solid increase. What drove that?
Primarily two things. They mentioned about $143 million, or Zalongo 17 a share, coming from what they call rider equity return.
Okay, break that down. Riders.
Basically, it's the approved profit they earn on specific large infrastructure investments they've made. Think grid upgrades, new power generation, stuff regulators approved.
So their capital investment plan is paying off.
Seems like it. And the other driver was about $52 million or dollars of success a share from just increased customer usage and some other factors, people using more power.
Which is a good sign for the economy and their service area, too.
True. Now, there were some offsets. They sold off a non-controlling interest, which reduced earnings a bit, and weather had a small negative impact, about a penny per share.
Minor things compared to the growth drivers, though.
Definitely. Okay, moving south now. Dominion Energy, South Carolina, or DES.
Right.
Here, operating earnings hit $109 million this quarter. That's up $40 million from last year's $69 million.
Another strong jump. What was the story there?
This one was pretty straightforward, primarily driven by $40 million, or $0 or 5 a share, from base and RSA rate case impact.
Regulatory outcomes. So they got favorable decisions on their rate reviews.
Looks like it. Those adjustments allowed them to collect more revenue this quarter.
That's often a key driver for regulated utilities.
For sure. But, not everything was up. Let's look at contracted energy.
Okay, what happened there?
Operating earnings actually decreased. They came in at $47 million, which is down $53 million from $100 million last year.
Oof, that's a pretty significant drop. Any specific reason?
Yeah, a clear one. About $62 million, or 0.07 cents a share, of that decrease was due to planned outages at their Millstone nuclear plant.
Millstone. Scheduled maintenance, refueling, that kind of thing.
Exactly. Necessary work, but it means the plant isn't generating power or as much power during that time, which hits revenue.
Right, a planned temporary impact. That's the kind of thing operating earnings might smooth out over a longer period, but it definitely shows up in a single quarter.
Good point. And finally, there's the catch-all. Corporate and other.
Usually a loss center, right?
Yeah.
Holding company costs, interest.
Typically, yeah. But it actually improved this quarter. The loss narrowed by $31 million. It went from an $87 million loss last year to a $56 million loss this year.
Okay, so less of a drag on overall earnings. What helped there?
Main factors were a positive change in net interest expense, maybe lower borrowing costs or better debt management, and also lower corporate service company costs. So some cost control happening at the corporate level.
Makes sense. So if we sort of zoom out from the quarterly numbers, connecting this to the bigger picture, who is Dominion Energy today?
Good question. Give us the overview.
Well, they're headquartered in Richmond, Virginia, as you'd expect. Huge regulated utility footprint, providing electricity to about 3.6 million customers across Virginia, North Carolina, and South Carolina. Plus, regulated natural gas service to about 500,000 customers just in South Carolina.
Okay.
But what's also really important and ties into their future is their clean energy role. They are seriously one of the nation's leaders in developing and operating regulated offshore wind.
That big project off the Virginia coast.
Exactly, the Coastal Virginia Offshore Wind Project.
Yeah.
Plus, lots of solar. And they're actually the biggest producer of carbon-free electricity up in New England, thanks to Millstone.
Ah, right. Nuclear being carbon-free.
Yep. So their stated mission really reflects this mix, to provide the reliable, affordable, and increasingly clean energy that powers its customers every day.
Reliable, affordable, and clean. That's the balancing act.
It really is. And they're always careful, as they should be, to mention the risks, the forward-looking statements disclaimer.
Yeah, you always see that.
Things like weather, obviously. Regulatory changes are huge. Big project execution risks, like actually getting that massive offshore wind farm built on time and budget.
And demand fluctuations too, right? Like all the new data centers popping up.
Absolutely. Plus, just the technological challenges of integrating all these new clean energy sources. It's a really complex, dynamic environment they're navigating.
So bringing it back to the listener, why wade through all this? What does understanding a report like Dominion's Q2 results actually do for you?
Well, a few things, I think.
Yeah.
First, it just helps you gauge the financial health of a company that might be providing your power. Or maybe it's in your retirement fund, it's a major player.
Right, basic financial literacy about important companies.
Second, you get real insight into what drives profits in the energy sector. You see the impact of regulation, investment, fuel costs, even planned maintenance. It helps you understand the news better.
And maybe apply that understanding to other utilities too.
For sure. And third, just practically going through this gives you a kind of template. You learn how to cut through the noise in these financial releases and find the key information quickly.
Yeah, building that skill to parse these reports.
Definitely. So if I had to recap the core insight from this quarter,
Go for it.
Dominion put up strong Q2 operating earnings. They held their full-year guidance steady, which signals confidence. And while there were segment ups and downs, like the planned Millstone outage,
Right.
the overall picture, especially in the regulated businesses like Virginia and South Carolina, looks pretty robust.
Yeah.
And the key, really, is understanding the GAAP versus operating earnings distinction to see what they consider their fundamental performance.
Okay, solid summary. That leaves me with a final thought, maybe a question for you, the listener, to chew on.
The provocative question.
Yeah. Given Dominion's big commitment to increasingly clean energy and these massive investments they're making, like in offshore wind, how do you think these huge multi-year projects will continue to shape their earnings reports in the future?
Good question. Big spending now, potential payoff later.
Right. And what does that signal about the broader energy transition that's happening all around us? It's definitely something to watch. We hope taking this deep dive approach helps you apply this kind of analysis to other companies or topics you're interested in.
Keep digging deeper.